Imagine for a second that you are sitting there running a massive, globally recognized Fortune 500 company.
Okay, I am picturing it.
Right, so you're in this glass-walled boardroom, tension is super high, and your board of directors is basically staring you down with one clear mandate.
Let me guess. They want AI.
Exactly. They want you to implement AI across the entire company, like yesterday. They want those massive efficiency gains, the autonomous operations, and most importantly, they want that stock price premium the market is giving to AI-first organizations.
Oh, Wall Street loves a good AI press release right now, yeah.
For sure. So you nod, you smile, you promise them the future. But beneath the surface, you're dealing with a totally terrifying reality.
Legacy code.
Yes. You know your entire tech stack, the actual digital plumbing of your multi-billion-dollar business, is running on decades-old code. You have databases from the early 2000s.
Right, and inventory systems held together by, digital duct tape.
Exactly. And institutional memory from engineers who are about to retire. You can't just plug a state-of-the-art neural network into a 1985 mainframe and expect magic. The infrastructure will just completely collapse.
It's the defining corporate dilemma of this exact economic cycle, honestly.
It really is. So the question is, who do you actually call to do the brutal, highly specialized work of ripping out that old plumbing?
Which is not pretty work, by the way.
No, not at all. And that is exactly what we are answering today. Welcome to Talk Tickers, where we break down corporate earnings calls for you, the retail investor. Today we are doing a deep dive into the Q2 2026 earnings call for Grid Dynamics.
Ticker symbol GDYN for those following along.
Right, GDYN. They are an IT consulting and services firm. We've got their financial results, management commentary from CEO Leonard Lifshitz, and the analyst Q&A from July 30, 2026.
And you really should care about this one because this deep dive isn't just about one mid-cap company.
No, it's a playbook. We are extracting the exact playbook for how a tech services company is actively monetizing the AI boom, moving way past the hype phase and into actual real-world enterprise infrastructure.
Yeah, and physical robotics too, which we will definitely get into.
Oh, we are definitely getting into the robots. Okay, let's unpack this. Our goal today is to give you the data-forward, actionable insights. We're going to hit the headline numbers, the story behind them, management's guidance, and our bottom line on the stock.
Love it. So let's start with those headline numbers because in a pretty cautious enterprise spending environment, Grid Dynamics put up a surprisingly muscular quarter.
They really did. Top line revenue hit $108.2 million.
Which is a 7% year-over-year growth, right?
Yep. And it actually beat the top end of their own internal guidance, which was $106 to $108 million.
And when a company beats top-end guidance right now, that tells you their services are viewed as essential infrastructure, not just, discretionary budget fluff that gets cut when times get tough.
Exactly. And looking at the bottom line, non-GAAP EBITDA came in at $14.7 million.
Translating that Wall Street jargon really quick, that's basically their core cash generated from operations, stripping out things like stock-based comp.
Right. Plain language. It's the actual cash they're making. And that $14.7 million is 13.6% of total revenue, hitting the absolute high end of their range.
Because of operating leverage, mostly. They are growing revenue without growing their internal overhead, which is exactly what you want to see as an investor.
For sure. But the aggregate numbers only tell us half the story. The real insight is where that money is coming from.
The verticals.
Yes, the verticals. TMT technology, media, and telecom is their massive driver. It brought in $34.4 million this quarter.
Wait, what was the year over year on that?
Up an astonishing 36.4% year over year.
That is explosive for an IT service provider right now.
Totally. Then you have retail, which was kind of flat year over year at $28.7 million, but it did grow sequentially. And finance hit $24.8 million.
So what's the story behind these numbers? Management actually called it out explicitly on the call. It's this trend of vendor consolidation.
Right. Explain how that actually works in practice.
So over the last decade, massive Fortune 500s just accumulated dozens, maybe hundreds of different IT vendors. One shop for a database, one offshore team for QA testing, another for front-end web design.
Just a totally unmanageable web of contracts.
Exactly. And a massive security risk. So what we're seeing now, especially in TMT and finance, is these huge clients are brutally culling that list.
Cutting the long tail.
Yeah, cutting the legacy providers who don't have the scale or the AI chops and giving a way more wallet share to deeply embedded partners like Grid Dynamics.
Okay, I hear that, but let me push back here as an investor. If you look at their customer concentration, their top 5 customers now make up 43.5% of their total revenue.
Which is up from, what, 37.5% last year?
Yeah. And their top 10 customers make up 61.5%. Isn't this just putting all your eggs into a very small, highly demanding basket? I mean, if one tech giant sneezes, doesn't Grid Dynamics catch a massive cold?
It's a totally fair bearish concern. It is the classic double-edged sword of enterprise consulting. But you have to look at the stickiness of this new business model.
Stickiness meaning they can't be easily fired.
Exactly. These aren't temporary standalone app building projects anymore. Grid Dynamics is embedding their proprietary AI platforms, they call it GAIN, the Grid Artificial Intelligence Network, directly into the core infrastructure of these huge companies.
So they become the actual nervous system of the client's operations.
Right. And once you install a proprietary AI platform to run a client's core logistics or finance data, ripping that vendor out a year later is technically terrifying for the client. The switching costs are just astronomical.
Okay, that makes sense. It's a highly durable commercial relationship. But to understand why they're winning these consolidated contracts, we really need to look at what they're selling. Which brings us to the AI inflection point.
The tipping point from just playing around with AI and pilots to actual live production.
Exactly. And this is a huge data point for anyone holding the stock. AI revenue crossed the 30% threshold for the first time ever, hitting 30.7% of total revenue.
And growing 54.6% year over year, which is just wild.
It is. But there was this one specific kind of dry sentence from CEO Leonard Lifshitz that I found fascinating. He said, "Fixed price is a preferred approach on new RFP responses."
Oh, that is the most important sentence in the whole transcript.
Translate that for us. Okay, so historically, the entire IT consulting industry bills by the hour, time and materials.
Yeah.
You hire a firm, they put a coder in a seat, and they charge you $150 an hour until the software is built.
The classic billable hour model.
Right. But think about what happens when you introduce highly capable AI into that model. If AI makes your coders 10 times faster, a project that took 100 hours now takes 10 hours.
Wait, so if you're still billing by the hour, you just destroyed your own revenue. Exactly. You're cannibalizing your own business because you got too efficient. So Grid Dynamics is aggressively shifting to fixed price contracts. They go to a Fortune 500 client and say, "We will modernize your supply chain for a flat $5 million.
Which the client loves because it's absolute budget certainty.
Right. But for Grid Dynamics, if they use their proprietary GAIN platforms and AI to do that work in a fraction of the time, they capture the entirety of that created margin. They keep the difference.
So they're basically monetizing the AI productivity boom directly into their own bottom line.
Yes, but you only do that if you are absolutely certain your internal teams are actually using the AI. If they screw up, you eat the cost.
Which explains this crazy internal mandate they have. They're requiring 90% of their engineers globally to be trained on their proprietary AI software development lifecycle by the end of October 2026.
90% of a 5,000-person workforce. That's a massive shift. AI-first delivery is now their default, not just a goal.
And they gave some concrete examples of this in the real world that are just mind-blowing. Let's talk about the food service distributor.
Yeah, this is a great use case.
So this is a massive wholesale company. They used to process product credit claims totally manually.
Yeah.
A restaurant gets a pallet of crushed tomatoes. They send in a photo, and a human had to look at it, cross-check the labels, verify the codes.
Which takes forever and is super expensive.
Right. So Grid Dynamics built an AI platform to completely automate this. It uses computer vision to read the shipping labels and barcodes right from the unstructured photos.
And the performance numbers on this were insane.
Insane. It processed a batch of 400 claims, looking at 1,000 different images in under 15 seconds per claim.
See, that is clear, quantifiable ROI for the client. You speed up the cash cycle, make the restaurant happy, and free up the human sales reps to actually go sell things instead of staring at pictures of rotten tomatoes.
Exactly. And they did something similar for a Fortune 30 home improvement retailer. They built an AI routing system for logistics that dynamically figures out how to put fragile items on trucks with the right suspension.
Because AI can calculate all those variables instantly. Traffic, truck weight, driver shifts, fragility.
Right. And it cut their average delivery time by more than half, from 3.5 days down to next day delivery. Management thinks it could support $500 million in incremental annual revenue for that retailer.
$500 million. I mean, that's why they want fixed price contracts. You don't bill hourly when you're unlocking $500 million in revenue. You want a piece of that massive value creation.
Totally. So they're absolutely crushing it in software and data. But as I was reading the transcript, it took a really wild turn, like sci-fi movie territory.
Horizon 2. The physical AI bet.
Yes. Here's where it gets really interesting for investors looking at long-term growth. They aren't just sticking to digital software.
Right.
They are aggressively moving into physical robotics.
Which is a market measured in the trillions over the next decade. But it is vastly harder than digital AI.
We'll break that down. What's the real difference between generative AI that writes code and physical AI?
Okay, so if an AI agent writes bad software code, it can just test it in a digital sandbox, run a million simulations in a second, fail, and try again. The cost of failing is zero.
Right, just resets.
But a physical robot has to deal with gravity, lighting changes, real-world geometry, a factory floor full of unpredictable humans.
So you can't just plug ChatGPT into a forklift and hope for the best.
No. The cost of a failed physical iteration isn't a bad line of code, it's a destroyed product. Or worse, an injured human worker.
The analogy I thought of was teaching a teenager to drive. You can teach them all the rules from a book, the software model, but putting them behind the wheel on a rainy, slippery highway requires a totally different level of physical, real-time control.
That is a perfect analogy. You need extreme sensor fusion. And to solve this, Grid Dynamics acquired a highly specialized robotics engineering team called Ekumen back in May 2026.
And they partnered with Doosan Robotics for the hardware, right? And NVIDIA.
Yes, Doosan makes the cobots collaborative robots, and NVIDIA does the hardware compute layer. But the Ekumen acquisition is the secret sauce here.
Because of their background in ROS, right? The robot operating system.
Exactly. ROS, and now ROS 2, is the open source standard for the whole robotics industry. And Grid Dynamics didn't just hire people who use it. Ekumen engineers are foundational maintainers of that actual standard.
They literally write the rules of the road for the industry.
Right. And they use their own proprietary platform called Incarnum to build these robotic workflows.
And the real-world application they mentioned was fascinating. A leading life sciences company is running a pilot project with humanoid robots for warehouse logistics.
Moving and repacking containers of chemicals autonomously.
Which requires such intense dynamic balancing and precise grasping so it doesn't drop hazardous materials.
I mean, doing that with unstructured data in a live warehouse was basically impossible 3 years ago.
And they're also building autonomous driving stacks for heavy construction and mining equipment. Massive, multi-ton machines.
It's flashy, and it's definitely the future. But if we're being honest as investors, the real money today isn't in flashy humanoid robots.
No. Where is it?
It's in the least flashy industry on Earth. Legacy banking infrastructure.
The banks. Yes. This is section 4 of our deep dive, agentic engineering. And the numbers here are moving incredibly fast.
It's wild how fast they are closing these deals.
Right. So they have this platform called Allium, which is part of their Gain suite. They're currently piloting it across 5 major Tier 1 banks.
Yeah.
And they mentioned a North American bank that signed a contract just 2 months after a 1-hour demo.
2 months in enterprise banking software sales is unheard of. That usually takes a year of compliance reviews.
Right. So what is the existential problem they are solving that gets a bank to sign that fast?
It comes down to fear. Bank executives want the speed of AI, but they are absolutely terrified of regulators, security vulnerabilities, and AI hallucinations.
Because if an AI writes bad code for a bank, it could misdirect billions of dollars.
Exactly. There was a great quote on the call from Eugene Steinberg, their head of strategy. He said, "An agent can write a code. A person still makes a call and stands behind it."
The banks need human accountability.
Right. And these banks are sitting on mountains of legacy COBOL code from the 1970s. The people who wrote it are retired or dead. The banks don't even fully understand their own business logic buried in there.
So they are terrified to touch it in case they break an overnight batch process that settles millions of credit card swipes.
Yes. So how Allium works is they deploy AI agents to read that ancient COBOL line by line and work backwards to create functional specs. It writes the instruction manual for what the old system actually does.
And then once that's validated, they build a modern replacement.
And they wrap the whole thing in rigorous security. They mentioned supporting a security modernization program at one bank spanning over 100,000 discrete systems.
100,000 systems. You literally can't do that without AI automation.
Impossible. And when the AI finds a security flaw, it actually translates that issue into failing tests right inside the bank's own internal software dashboards.
So the human engineers at the bank can verify it themselves. That builds massive trust.
Exactly.
But wait, let me ask the devil's advocate question here. If the AI is writing 90% of the code, which they literally did for that Fortune 30 home improvement retailer, why do they need to hire Grid Dynamics?
the billion-dollar question.
Seriously, why doesn't the bank's CIO just buy an OpenAI subscription and tell their own IT department to do it? Why pay a premium to Grid Dynamics?
Because of domain knowledge, governance, and control. Writing the raw code is only 10% of the battle in a regulated enterprise.
Getting it into production securely is the real nightmare.
Exactly. Grid Dynamics is building the agentic harnesses, the operational guardrails that ensure the AI only takes specific actions, records everything for an audit, and stops if something looks wrong.
They provide the adult supervision.
Right. The value isn't generating the code anymore. The value is taking responsibility for it in production. That is their massive competitive moat.
Which really alters what their own workforce looks like. Let's look at the talent shift, because this is our fifth key takeaway. The headcount numbers tell a huge story.
A really clear indicator of where the whole tech labor market is heading.
Overall, total global headcount dropped this quarter from 4,964 down to 4,838. They are rationalizing non-engineering and non-billable roles.
Nodding the fat.
Yeah. But their US-based onshore headcount actually grew to 7.8% of the company, hitting 379 employees. And meanwhile, non-GAAP gross profit margin improved to 36.9%.
If we connect this to the bigger picture, this is the definitive end of the traditional butts in seats offshore IT model.
The labor arbitrage model is dead.
Exactly. Clients don't just need cheap coders in Eastern Europe or India anymore because AI does the cheap coding. They need high-level US-based systems architects sitting on-site in their boardroom.
For change management, right?
Yes. Figuring out which business processes to actually automate in the first place. Dealing with corporate politics, mapping out the ROI. You can't outsource that to a junior dev 12 time zones away.
So they are engineering a more profitable company, higher margins, fixed price AI delivery, even with fewer total employees, by focusing on that high-value onshore consulting.
It's a textbook execution of moving up the value chain before your old business gets disrupted.
Okay, so the internal house is in order, products are landing. Let's hit the management guidance and the industry headwinds to round out the Talk Ticker's actionable outlook.
The forward-looking data.
Right. Q3 guidance is projected at 112 to 114 million in revenue, and they maintain their full-year guidance of 435 to 465 million.
Maintaining the full year is a strong signal of structural confidence.
For sure. And a big part of that confidence is their channel partnerships. Partner influence revenue is at 19.1% right now, and Lifshit said the long-term target is 25 to 30%.
And we should be clear, these aren't small partners. This is Google Cloud, AWS, Microsoft Azure, the hyperscalers.
They just had their first ever joint win with Google in the global banking sector.
The hyperscalers are acting as massive sales funnels for Grid Dynamics. Google sells the raw cloud compute, but they don't have an army of consultants to fix a bank's COBOL problem. Grid Dynamics provides the skilled labor to build the actual factory on top of Google's cloud.
It's a brilliant go-to-market strategy.
Yeah.
But so what does this all mean? Is it just smooth sailing to the trillion-dollar robotics future? Or should investors be worried?
There is a real storm cloud on the horizon, and Lifshit's warned about it.
The uncertainty.
Yes. Enterprise clients are hesitating because of the sheer operating cost of running AI at scale, specifically the cost of tokens.
Oh, tokens.
Yeah.
Explain the mechanics of that really fast for the listeners.
Sure. So a token is basically a fraction of a word. When you ask an AI a question, it processes your prompt in tokens and generates the answer in tokens. And the client pays a microtransaction fee for every single token to Microsoft or Google.
So the meter is always running.
Constantly. Historically, you buy a software system for 10 million bucks, install it, and the ongoing cost is low. With generative AI, building it is just the start. Every time an employee uses it, the token meter spins. It's a massive variable operational expense.
So if a bank deploys an AI agent to 100,000 employees, their daily compute bill paid to Google could be astronomical.
Exactly. So CEOs are hitting the brakes. They're saying, if this costs me 50 grand a day to run, can you mathematically prove it's saving me 50 grand a day in labor?
The ROI has to be crystal clear.
If it isn't, they just kill the project, which is exactly why Grid Dynamics is pivoting so hard into that high-level onshore change management consulting. They have to prove the business value up front to get the tech actually deployed.
Wow. Okay, so summarizing our deep dive today, Grid Dynamics is beating expectations through vendor consolidation. They are massively shifting to fixed-price AI deployments to protect their margins.
They're piloting chemical-packing humanoid robots with Horizon 2.
And securing legacy banking code with Allium. It is an incredible technological evolution.
It really is. But I want to leave you, the listener, with a final provocative thought to mull over.
Oh, I love a good final thought. Give it to us.
Okay, historically, Grid Dynamics is an IT service provider, a consulting firm, right?
Great.
But look at what they're doing today. They are deploying proprietary platforms, Gain, Allium, Incarnum, directly into the deepest core infrastructure of Fortune 500 companies. If your proprietary software becomes the indispensable operating system for your client's business, are you still just a consulting firm?
Oh, I see where you're going.
Or are you actually a highly scalable, high-margin enterprise SaaS company in disguise? Because financial markets value consulting firms modestly, but they value sticky SaaS platforms at a massive premium.
That is a brilliant point. Have they built the ultimate Trojan horse? Selling engineering hours, but actually deploying a software empire inside their clients?
Something to watch very closely if you're holding the stock.
Definitely. Thank you for joining us on this deep dive. The tech landscape is shifting faster than ever, and the old rules are officially dead. Keep questioning the world around you. Always look for the story behind the numbers, and we will see you on the next deep dive.